can be one of the biggest expenses in your property business. However, it doesn't necessarily have to be if you can mitigate it using the right strategies and techniques. Rishi Sunak, the Chancellor of the Exchequer and the person that's been put in charge of managing the country's finances, and also the person who sets our personal tax rates, is being in a little bit of sticky water recently due to their personal tax affairs. Now let's get things straight here. They haven't necessarily done anything illegal. Maybe it's a little bit immoral what they're doing, but they're taking benefit of the tax rules that exist to pay little to no tax. In this video, I want to give you 6 ways for you to mitigate your property tax. Hey, if you're watching my videos for the first time, my name is Saj Hussain, and on this channel I share with you my 15+ years of property investing experience to ultimately help you get further faster in your own property investing journey. Now, Rishi Sunak's wife has been in the news recently because she's registered as a non-dom and doesn't pay any tax on her overseas income. So what that means as a non-domiciled, it means that she can benefit from living in this country but not paying the taxes on money that she earns outside the country. So what money does she earn from outside of this country? Well, she's a daughter of a billionaire, a software entrepreneur, and she has a portion of the dividends from that particular business, a very small portion, but that small portion gives her dividends of about 10 or 11 million pounds a year, and the tax on that would be about 2 million pounds. So that means she saves about 2 million pounds tax a year just from that one source of income by being registered as a non-domicile. So what does that mean? Well, they're not breaking any rules, but what they're doing is taking advantage of the tax rules that exist. And sometimes people talk about the rich don't pay very much tax. It's really everybody else that pays tax. And that's because the rich can take the time and spend the money to find the best possible accountants, to find the methods for them to absolutely minimize their tax bill by working within the rules. So for example, when we look at companies like Amazon and Starbucks, who were also in the news a few years ago, who were paying very little tax in this country, really just because they were taking advantage of the rules that already exist. Now, there's a difference between whether it's morally right or whether it's legally right. So here they're doing nothing illegal, but there might be questions around how moral it might be in terms of what they're doing with the amount of money that they're making, but avoiding paying any tax in this country. The point I'm trying to make is if you understand tax, you don't have to pay a huge amount of tax, but you can mitigate and reduce the amount of tax you have to pay. Yes, we all have to contribute towards society and pay tax, but you don't have to pay more than you absolutely necessarily have to. This reminds me of a quote from Morgan Stanley, which says, "We've got to pay taxes, but there's no law that says you've got to leave a tip." What I'm talking about is nothing new. Some of the most wealthiest people in this country pay a tiny amount of tax compared to the income that they generate and the overall wealth that they have. That's because they utilize the rules and the laws that already exist. Now, when it comes to property taxes, there's 5 key taxes that we need to really be aware of that impact us directly. The first one is stamp duty land tax, or stamp duty as we often refer to it as. This is the tax that we pay when we're purchasing a property or a piece of land. Now, not only do we pay the regular rate that most people pay as property investors, we have to pay an additional 3% over and above that as well, which was something the government kindly introduced a few years ago for us. Now, often what happens at the point of purchase, you get your solicitor to take care of the paperwork for your stamp duty, and they look at the standard rate and they pay that. However, stamp duty is a very complex area, and often it needs the right type of accountant, not solicitor, a specialist accountant that understands this area of tax, that can really help you mitigate your tax by setting the transaction up in the right way. Just for example, a property that we purchased a few years ago, which is a commercial building, the intention was to use it for residential use, and because there was VAT on there was been about £80,000 of VAT we would need to pay, but by changing the structure in the way we were purchasing it meant that we did not now need to pay that £80,000 of VAT. Just an example of, by understanding stamp duty, how you can make a massive saving on your overall purchase. Number 2 is capital gains tax. This is a tax that's paid at the disposal of assets that you hold individually or maybe within a partnership. So for example, myself and my wife, if we purchase a property and we sell that for a profit, this is not our home, an investment property that we sell, we'll have to pay capital gains tax on that. And that's either at 18% at the lower rate or 28% at the higher rate. However, every individual has a £12,300 a year tax allowance. That means you don't need to pay tax on that first £12,300 gain that you have. So for example, there's 2 of you, let's say you made £20,000 gain on a disposal, there's no tax to pay as long as you've structured the deal in that way. Number 3 is corporation tax. Now, if you're purchasing a property within a company and you're making a profit there, then there's no capital gains tax to pay, but there's corporation tax to pay, which is currently 19%, but there's talk of that maybe increasing in the future as well. Number 4 is income tax. Income tax is what the tax most people pay on their earnings that they have. So for example, that could be on rental profit that you're making, the tax you need to pay. But again, if there's say more than one of you, yourself, maybe your spouse, then it's important you're utilizing your tax allowances to be able to reduce the overall amount of income tax that you're paying, or staying below certain thresholds to minimize your tax. And finally, number 5 is Section 24 tax, which was gradually introduced over the last few years. And this now meant that the income that we generate from property, i.e. your rental income, you can't offset your mortgage costs if you own the property in your personal name as a cost. And effectively, you're being taxed overall on the rent, i.e. the gross income that you're collecting, as opposed to the net profit that you're making. This doesn't really apply to any industry. I think personally, this is absolutely crazy that they've done this. But hey, here's the thing, it applies to everybody, so we've all got to work within the system. But as creative property investors, we always find ways and solutions to potential problems. That's what we do. So most people over the last few years have been incorporating, i.e. by working within a limited company status rather than buying property in their personal name, so they're not impacted by Section 24. And if you want to learn more about how that works, I'll link a video up here I've done previously for you to watch. Before I share with you the 6 ways that you can reduce your tax, if you're enjoying this video, then do me a favor, make sure you hit that like button, but also more importantly, subscribe to the channel. And that way it just really helps us to reach more people. And remember, subscribing to the channel and liking this video is absolutely free. So why wouldn't you? So go on, get that done now. The first thing that you should be doing to reduce your tax sounds a little obvious, but you need a really great, competent accountant. Now, this is not just any type of accountant, but really what you need is a specialist property accountant that has the right understanding and expertise on how to minimize your tax. Because hey, look, a general accountant can be able to help you, be able to put together your books for you, do your end of year accounts for you, but they're not really going to have the intrinsic knowledge required and all the different techniques that you could be using and utilizing to reduce that tax. Now, we work with lots of great accountants and lots of great property accountants. And if you want some help in that area, just reach out to us and we'll try and connect with one of those to help you there as well. The second thing that you should be doing is making sure that you are putting through all your allowable expenses through the business. Now, sometimes you'll be incurring little costs here and there, traveling to a meeting, maybe some mileage, maybe purchasing coffee and snacks for a meeting that you're having. All of these things are expenses that you can offset in the business, but what you want to do is make sure that you're doing that. However, remember, if a property is in your personal name and a tenant rings you up because there's a problem at the property and you go to fix that little bit of a maintenance issue that you go to deal with, that's not going to be an expense that you're going to be able to offset. You can't charge yourself for that expense. However, if you've got a third-party company like a limited company, and you could charge the repair through that, and that way that cost can be offset, but effectively you're moving that into the company. Really, it's thinking about these things in a holistic way rather than in isolation. The third method is something I touched on earlier on. That's if you have a partner, a spouse, a family member, someone that's working with you in the business, make sure that you are utilizing their tax allowances, because everybody has an annual tax allowance. That's how much money you can earn per year, usually around £10,000 that you can earn before you start paying any tax. So you want to make sure you're utilizing that and minimizing your tax that way. The fourth method is by using limited companies and LLPs and even group structures to set up, and that way you've got more control over where you're creating the profits in which company and which entity in order to mitigate your tax overall. The fifth way is thinking about properties that you already own, whether you can use them in a different way to reduce the tax if that's become a problem. So for example, if you've got a property in your personal name and Section 24 is really hurting you, could you turn that property into a furnished holiday let, which means that now it moves outside the scope of Section 24 because it's no longer treated as a regular buy to let, because a furnished holiday let is treated in a different way, i.e. serviced accommodation. The sixth and final way is also another way to get around Section 24, and that's to invest in commercial property, because when you're investing in commercial property, Section 24 doesn't apply. It's only for residential property in your personal name. What I've shared with you is just a few examples of how you can reduce your tax. After speaking to lots and lots of property investors over the years, I realize there's so many that really just bury their head in the sand when it comes to tax and don't really understand how they can really mitigate their tax and reduce the amount of tax that overall they're having to pay. Remember where I started this video, reducing your tax is not illegal, it's just understanding how to use the system and work best within that. If you have enjoyed watching this video and you want to learn more about company structures and buying property in personal name, which is the right one, then make sure you watch this video that I've got lined up over here for you next. But just before you go and do that, make sure if you haven't already, click on my face down here to subscribe to the channel, and then I look forward to seeing you on this video just up here.